Hello, everybody. It's your boy, Sean McLaughlin. Today is Thursday, January 9, 2025. I apologize if my voice sounds weird. I'm incredibly sick. In fact, as soon as we're done with this, I'm going right to bed. Um, so if my voice sounds funny to you, I apologize. And if I cough, I apologize. But it's been a rough couple of days here at my house. Good news is I feel a little better than I did yesterday. So hopefully we're on the mend. But this is the All-Star Options Jam session. For those of you new here, what we do is we review action amongst the trades that we have on the books, any action that has taken place over the past week, any positions we've exited, whether for a profit or a loss, any adjustments we've made, and we have all of the above to discuss today. We also review updating stops on positions that we have open, if any need it. And then we touch upon the new trades that we've put on since we last spoke. But before we get into all that, let me just drop the old disclaimer here, as always, that everything we discuss here is for educational purposes only. And I hope that you are learning something from watching me go through my process. That's the goal here. All right, so let's look at the high level here, the S&P 500. Boy, we've just been chopping around for the last 2 weeks. Had a pretty ugly red candle day. Was that Tuesday? I don't know what to make of this action, to be completely honest with you. We've been chopping around. We really need some decisive action. I thought the semiconductors finally showed their hand to the upside a few trading days ago, but the market had other ideas. So we're kind of in a weird zone, which is really uh, i- in keeping with the theme that I think we're heading into this year, that the bull market will likely continue. I think we'll finish 2025 higher than we started, but I don't think it's going to be smooth. I don't think it's going to be straight in one direction. I think we're going to have a lot of pullbacks and it's going to be choppy. Um, and I think this week has been a reminder of that. All right, so again, we're gonna go through this kind of quickly because I feel like crap. So let's review the positions we've closed. We got a bunch of closed positions this week. None of it's really good news, although some of it is. Um, let's talk about this one. I mean, this one stings a little bit. We were long Aurora Innovation AUR. We're long the June 10 calls. So we were long the June 10 calls. We paid $1.25 for them. We got stopped out on January 2nd, and what appears to be the low price of the move. The stock immediately ripped back higher since we got out. I am no longer in this position, but if some of you find that you're still in this position for whatever reason, maybe you were on vacation and you weren't watching your portfolio, if you're still in the trade, I think you stay with it. I mean, this reaction here a couple days ago, I mean, yeah, it's been very volatile, of course, but I think this action, if you're still in this position, you got to continue riding it. You know, maybe you put your stop right below this low here around $6. But I'm out. Unfortunately, risk management is job number one. Of course, I had no idea this thing would gap higher a couple days after my exit, but you know, got to stick to the process. So we're out, or I'm out of AUR. But if you're still in it, I say keep riding it. All right, TME, 10 Cent Music. We were long the March 15 calls that we got into back in September. Stock, man, it looked like we had timed a beautiful entry when we first got in, but it has since given it all back and then some. And we got stopped out. We had raised our stop loss level up to $11, and we closed below that the other day. Got out for 15 cents. We paid 55 on the way in and got out at 15 cents. So not 100% loss. But still a loss. Next up is Revolve Group. This one also looked like we had timed it really well. But the market's been weighing out a lot of stocks, and Revolve is just kind of traded with what's going on under the hood. There's been a lot of selling in a lot of stocks outside of the big cap names, and this one got caught up. We were along a bull call spread in March. We paid 340 for it. We got out yesterday or 2 days ago. No, yesterday at a buck 50. So not a total loss. We'll take it. All right, some good news. Let's talk about some good news and something that I screwed up. Mea culpa here. We got long this YPF, the Sociedad Anonima. I'm probably butchering that name. I apologize. But we got long a bull put spread. So we sold premium. This was not a trade that had unlimited upside. It was a trade that had a high probability of a win. And we sold this put spread for $1.40. And just seven or some a week later, basically, I closed the spread at 60 cents, booking a profit. Now, I don't feel bad about taking a profit, but what I do feel bad about is that I didn't follow my own plan. I made a mistake. The plan that I laid out in the blog post when we put this trade on, which, by the way, if you're not aware of this, we put detailed trade plans for every trade that we put on, where we're getting in, where we're getting out, all that stuff. It's all in the trade plan. And in the trade plan that I published, I said that I would leave a limit order at 50 cents to buy back this spread. So a little bit more than 50 cents, 50% of the total credit, right? I collected $1.40. I mentioned in my piece that I wanted to buy it back at 50 cents so that I would get, about 70% of the original premium collected. Where I screwed up is that, in years past and in times past, normally my best practice is I'll buy a short credit spread like this. I'll buy it back for half of what I sold it for. So if I sell it for $1.40, I'll buy it back at 70, right? So muscle memory kicked in when I put the order into my platform and I put the good till cancel order into the platform. I put my order in to close it at 70 cents. Again, just muscle memory because I've done it so many times. I had forgotten that I had mentioned I wanted to close it at 50 cents. So I am out. I booked a profit. If you guys saw me in the chat, I mentioned in the chat that I got out. If some of you got out at that price too, congratulations. You had a nice win. I don't know if you got an opportunity to close it at 50 cents. I don't think we did. So you might still be in it. And if you are, still like the trade. It's still a good looking trade. It's doing what we want it to do. But we are out of YPF at a profit target. All right. Next up is Hilton, HLT. Boy, I was really bullish on this name when we got in back in mid-November. And I said it at the time, and I'll continue saying it, is anyone who's tried to book a hotel room at Hilton or any hotel really these days, you'll notice that hotel prices are just through the roof, it seems like. It seems like everywhere I want to go, at least. Uh, Hotel rooms are very, very expensive. So I thought, well, hey, if you can't beat them, join them. Let's get long Hilton as a hedge to my travel expenses, right? I really felt good about this one, but we got to close below our stop loss level on Tuesday. So we got out yesterday. We had paid $6 for these June 290 calls. We got out for 257. So not a total loss. That's okay. Finally, FXI. This is a trade that we're still in. And this one's very interesting. I've got an email that's going out. I don't know if it's gone out yet, but it will. If you haven't gotten it yet, it's going to go out later today. And if you're not signed up for my free email list, guys, I've got the link in the chat. Sign up for it. It's free, right? And if you had signed up for that newsletter, you would have gotten an email. I'm not sure if it's gone out yet. I'll have to check, but it will go out today if we haven't gotten it yet. In FXI, this is a trade that we got in with a call calendar spread. Back in November 6th, to be exact. So this trade, back in November, we had the feeling, me and the team here at All Star Charts, we had the feeling that if we get some rotation into China, China could set up for a really, really big move, a move that could potentially make our year. And so we wanted to position ourselves with a long-term trade. So back in November, I bought the January 2026 35 strike calls. That had at that time 14 months until expiration. But I also had a feeling that this trade might take a little time to get working. So I wanted to systematically reduce my cost in this trade by selling calls against it. So we started this trade as a calendar spread. We had bought the January 35 calls and sold the December. Sorry, these were the January 2026 calls. Remember, these had 14 months to expiration. And we also sold the December 35 calls, which only had a month expiration at that time. And combined, it cost us 248. This should be a debit here. I apologize. I'll fix this, but that should say net debit, not credit. So if I just bought the 35 calls in that January expiration, I would have paid $3. But because I did the calendar spread, it actually only cost me 248. Now, the plan was I was going to roll those short calls when I get opportunities to do so to continue lowering my costs. And these circles here you see on the chart are points where we got opportunities to continue rolling. And we published a later piece that we updated our trade plan a little bit. Instead of just selling calendars or rolling the short calls at the same strike, we would lower the calls if we needed to, if the ETF continued going lower, which is what we have done. So now we are short the March 32 calls. Now remember, we started at 35, but we've rolled them down a bit. We've taken credits all along the way. And so this trade now, our current net debit in this campaign is $1.35. And why is that important? Well, the $1.35 is the most we can lose, right? If FXI goes to zero, which it won't, but if it did, the most we could lose now is $1.35. We started risking 248. Now we're down to $1.35. But what's even interesting, more interesting, is that notice how we got in here, November 6th. And then we've made adjustments along the way. We're significantly lower than where we started. When we started, FXI was trading just south of 32. Now it's breaking below 30. This was a new closing low for our position since we got in, right? But guess what, guys? My current net debit is $1.35. That's the most I could lose. If I were to close this spread now, so that means sell those long January 2026 35 strike calls that I own and cover the short March 32 calls that I currently own. If I were to close this position right now, as of yesterday's closing prices, I could close this position for $1.37. That's 2 cents higher than my risk in this trade right now. So even though this trade has not worked for us, it has not done what we wanted it to do, we could still get out of it at a scratch. I bring that up because this is just one of many examples of how crafting creative options trades gives us an opportunity to win when most people would lose, right? If somebody was a stock trader and bought FXI, they're losing right now. If someone just bought calls in FXI, they're losing right now. But because we did a call calendar spread and we had a plan to aggressively roll our short options to bring in some extra credits as we wait for this move to materialize, because we had that plan, it's keeping us in the game and keeping us at a point where we're not losing any money here. Yes, there's opportunity costs here. There's time spent monitoring these things, but hey, so far, I'm pleased with the way this is going. And if FXI digs in here and finds some support and starts moving back higher, we're going to be positioned very well for a good win. And I'm hoping to have opportunities to continue rolling calls a couple more times, maybe to the point where my net debit in the trade gets to close to zero. And then I'll let the short calls that I have eventually expire, and then I'll have a free ride on those January 2026 calls. Now, I apologize if all of that was very complicated. You could always email me or hit me up on Twitter or X. I'm happy to explain things further to you. But that's what's going on at FXI, and that's all the portfolio activity that has happened over the past week. Next, we'll bring up the new trades here since we last spoke. Again, all trade plans for every trade that we put on All-Star Options can be found at allstarcharts.com. Head to the members section, head to the options section. You will find all the detailed trade plans. So I don't have the details on these trades up on the screen right now, but you can find it there. And if you don't have All-Star Options, get involved. Get involved. But I will say that we got long Archer at Aviation. We have a bullish bet on in that one. We also got long. There's a Digimark Corp DMRC. Don't like the way it traded yesterday. That's an ugly start, but we're in that. And we put a bearish bet on here in Textron. Needed a little portfolio diversification against most of my long trades. So we got a bearish trade on in Textronic. Again, all those details can be found at allstarcharts.com. All right, let's update some stops. We only have one updated stop to talk about this week, ARC. This trade started out as a diagonal trade. It's now a vertical spread. We are long the, what are we long? We are long the March 55 calls and short the March 57 calls. So it's a vertical spread, a bull call spread at this point. We have no risk in the trade because of these two adjustments that we have. We've talked about this in videos past, but we have no risk in this trade. We're looking to sell the spread. The most the spread could be worth is $2, right? We're long the 55 calls and we're short the March 57 calls. The distance between those two strikes is $2, so that's the most the spread could be worth. I'm looking to sell it at $1.60. I think we'll get that. I We might get that pretty soon. I mean, it was looking pretty good. I think we were really close a couple days ago, but then this red candle day did not help. But I'm looking to sell for a buck 60. But we have no risk in the trade. If this thing goes to zero tomorrow, we still walk away small winners because of these credits we've had when we rolled calls. But I'm updating the stop here to 56. The 56 corresponds with the low print late last week. And it's meeting the 50 period moving average right there. I don't want to see ARC get below 56. If it does, I will sell the spread for whatever I can sell it for. And whatever I sell for just adds to the profit we already have built in to the trade. All right, everybody. I always like to share this slide for everybody, but we only have the one stop today, but that's it. ARC to 56. And then I'll leave you with this. If you have any questions about everything we talked about, please don't hesitate to email me at info@allstarcharts.com. It'll get routed to me. I'll be happy to help you out. I see that there's a couple questions here in the chat. Let me get to that real quick. Phil asked, any guidance on YPF for those of us who didn't get hit earlier this week? I talked about that earlier, Phil. But I'll just say, if you're still in it, the trade looks good. I mean, let's bring that up real quick. YPF. The trade still looks good. I mean, if I was still in it now, I'd be feeling good about it. It's doing everything we want it to do. We don't even need YPF to go up. We just don't need it to go down. We don't want it to go down. As long as it stays above 37, which is now pretty far away, this spread will likely pay you. So if you didn't get out at 70 like I did, or if you didn't get out at 50 cents, that's fine. But I would continue holding it. If I was still in it, I would continue holding it until it hit my profit target because it's looking pretty good. Yeah, as far as GME goes, Colin, we're still in it. We are approaching expiration. This is a bull call spread. Let's zoom in a little bit here. This is a bull call spread that has January expiration. So we need to keep a tight stop on this thing as we go forward. I'm keeping a stop. I'm trailing it just below the 3 to 5 day low. So you can see here the last 1, 2, 3, 4, 5 trading days. The low is right around 30. I mean, exactly the low exactly is 30.37 on this red candle day. So I got my stop at 30 right now, but as the days go forward over the next couple of days, as you can see, we'll be raising our stops as this continues to move our way. I should point out that I have a resting order to sell this spread at $8 if I'm lucky enough to get it. And if GME trades up to 38, which I mean, the way it's moving right now, it could very easily get to 38 in the next couple of weeks. So if it gets to 38, I'll have a really good chance of getting out of the spread for $8. So I have that resting order to sell it for a profit at $8. But we'll keep trailing a stop here for the next couple of weeks until we get out. All right. I think I addressed all your questions. Thanks for all the well wishes, guys. I wish I was in better spirits for you, but it's been a tough couple of days. I think I'll be better tomorrow. We'll see. We'll see. Anyway, thanks for tuning in, guys. Have a great rest of your week. Enjoy this market holiday today. Rest in peace, Jimmy Carter, former president. That's why we have the day off today. And boy, my best wishes and hopes go to all my friends in Southern California, in Los Angeles, all that stuff that's going on there, man. That's really, really scary. So if any of you are affected by that or near that or know somebody that needs some help, please help people out, man. That's a really scary situation. All right. Take care, everybody. I'll see you next time.